Okay, guys, welcome to our MSL series lesson number 2. And so last time we spoke about bull spreads, right? Playing to the upside and how you can finance your options for cheaper if something is costing a lot or something with high IV and the options are too expensive. Obviously, if the stock doesn't move that much then, or even if it does move, usually the intrinsic value has to be a lot to get paid, right? And especially when there's high IV. All right, so spreads are very useful when the market is sideways or when you're iffy, when the options are expensive, or when we're expecting a sudden hold in the market. Okay, so today what we're gonna talk about is playing the downside on something for cheaper, or selling the downside if we think the market is just going to hold and we're collecting premium. Okay, there are two spreads that I'm going to talk about. All right, the first one, we're going to talk about bear spreads. So this will involve puts, not calls, puts. Okay, first we're going to talk about put debits. All right, also known as bull put debit spreads. All right, these basically what's happening here is, let's say for example, if Amazon's trading at 113. All right, and I think it's going to go lower. All right, I think Amazon's going to go lower from here. It's not going to go up. And now we know that VIX is a high and puts are priced expensive. On put debits, basically what's going to happen is we're going to buy one option, right? If you think it's going to make a bigger move down, you can move the spread further down. All right, you can move the spread further down, which will cost you less money and the returns are higher. All right, but if you choose to do it in a safe way, if you choose safety, then you would buy something here in the money, and as long as Amazon stays in this range or a little below, and then your money, you can double your money almost. I want to explain how that works. Now let's look at number one. Let's look at the one spread that safe. All right, I'll use the word safety, where the chances of the spread working will be much higher. All right, are you guys on the page with me? This is only for premium members, so just not many people will be in because it's only for premium, and rest I'll record it for them. But you guys will get to experience this live and ask any questions that you may need to. Okay. So safety here would be, if I think, now this is, I don't know what else Amazon going to do here. This is just in regards, if I think Amazon's going to go down or maybe close at 110 or 111, maybe test it there. So basically what I could do here is, if Amazon is trading at 113 here, so I'll do these candles right here. So we have some well zoomed in. So if I think Amazon's going to be trading near 107, 108 by Friday, slow grind down, right? Let's say I'm aiming that Amazon's going to be trading around this range, maybe by Friday. How can I make money off it? Because if we buy puts alone, let's say if we buy Amazon's trading at 113, let's say 113 puts. Now these puts, let's say they're trading at $3. All right, I'm just going to make up some numbers, guys. Let's say these puts are trading at $3. Now, number one, if Amazon does not move too much, it just stays from 113, these puts are going to lose value every day. There's something called theta, time decay. All right, you guys are all familiar with this. I've taught you guys this many times now. So there's something called this. But let's say if Amazon even closes near 111 by Friday, Amazon makes a downside move. Well, these puts will only be worth $2 because of the intrinsic value. So you're actually losing money on buying puts alone here if we don't get too much IV. Or if Amazon just goes sideways like this. If this happens, so whether you buy calls or puts here, if you don't take an exit the second day, you lose money when the stock goes sideways, right? When your options lose money, even though the stock has moved in your way. Okay. So let's say, what would be a smart play here? If I think Amazon will close under 111, let's say. Let's say Amazon will close under 111. That's our technical analysis. So on that $2 move, how would you make money to the downside? So we bought the 113 puts at $3. Maybe I will sell the 110 puts. All right, I will sell the 110 puts. So these 113 puts. So now we're going to create a bull put spread. All right. Sorry, put debit to the downside. All right, bull put would be the opposite actually of collecting credit. So sometimes names do get confusing. So we're going to do bear put spreads. All right, debits where we buy to the downside. All right. So 113 puts we buy, and 110 puts we sell. Okay. Now, how much are 110 puts maybe going on here, given it's a Monday because the IV is high, the options are priced heavy. Let's say we're able to sell these for maybe $1.50. All right, we sell these for $1.50. Okay, so we get this money back. So this is debit. All right, money goes out of our pocket. This is credit. Money comes into our pocket. All right, so what's the total value of our spread? $1.50. Right, so $3 minus 150. Now this spread cost is $1.50. Now what's our intrinsic value here? For 150, if we're buying the 113 puts and 110 puts, we're selling, and this will actually cost us less than 150, by the way, because we're trading in the we're trading out of the money. This should cost us. So I'll just adjust this a little bit. Let's say these puts are going for 170. I would say. So the cost is $1.30. What's our intrinsic value of the spread? What's the intrinsic value? Anyone? Anyone? For puts, for the downside, what's the intrinsic value? No one? No, Keshav, that's not the intrinsic value. For us to break even on our Friday, if we hold it by until Friday, let's say we bought it for this week's thing, our cost is $1.30. Our first strike is 113. So our intrinsic value will be 130 minus 130 our cost. So 111.70. As long as Amazon closes below 111.70 and under, we will break even or make profits. And what's our max profits here, guys? What's our max profits? Anyone? What are the max profits?
130.
Nope. Our max profits. So the max value, number one, we want to find out is the max value of the spread. The max value is the difference between the strikes. So 113 minus 110. That's the max value of the spread, $3. So if let's say if Amazon goes below 110, it goes towards 108, 107. If it goes to 100, the market crashes. See, and when we do spreads, our profits are limited, but we're also paying less money, but they're much safer. The probability of them working is much bigger than calls or puts alone. All right, but calls and puts, calls alone is infinity profits. Puts, the max profits are all the way to 113 to 0. Well, I mean, it's not going to go to 0, but just saying, so you guys get the mean. But anyways, the max value of our spread is $3. The difference between the two strikes, 113 minus 110. All right, $3. So our max profits here will be $3. So this 3 minus 130, which is our cost. All right, we paid $1.30. So $3 is the max value minus 130. So $1.70 is our max profits we can get, which is still more than 100%. All right, so $1.30 plus 170. All right, so $1.70 is more than 100% of profits. Now, why do we do these spreads, right? Why? Let's say Amazon continues going lower. Let's say Amazon does its grind, is doing all these things, blah, 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 and then it ends up coming to 112. So let's say market is in a consolidation phase and you think Amazon visits lower. Let's say today's Monday, you bought this spread today, for example. Now we have until Friday. You don't have to hold it till Friday. You may exit the spread anytime you want. All right, anytime you want, you can exit the spread, just like calls and puts. But let's say tomorrow, Amazon goes higher, or not even higher. Let's say Amazon just stays here. I'm going to just go over a few scenarios about verbally. So just listen. Amazon stays around here. What's going to happen to our spread if it just stays sideways? Let's say, for example, the 113 puts will lose some value. Let's say 113 puts might be going for, let's say time decay hits. Let's say they're going for 250 maybe. All right, 250. We lost that time decay, but the 110 puts also must have lost some decay. Okay, so let's say these puts are probably going for $1.25. I don't know. All right, what's the value of our spread? Even though Amazon did not move, the value of our spread is still 250 minus 125. So we're still trading near break even. All right, but if you had the puts alone, you would have lost much more value. All right, you would actually lose more. I'm just still being safer. Giving more leverage to the market here, but your spread will actually keep you safe much more than your puts alone. All right, now, so that's one scenario if there's not much movement. Now, let's say, for example, if Amazon actually comes down, if Amazon comes down tomorrow's Tuesday. So if Amazon comes down tomorrow, let's say towards, I would say 110. Let's say Amazon comes towards 110 tomorrow, $3 move down. All right. So these 113 puts may be going for 450, not much. Why? Because there was already so much premium added in these, and these 110 puts are now near the money. Maybe these might be going for, let's say 250, for example. Not even 250, I would give it maybe 230-ish. All right, just based on my experience. Your spread value here now is, you bought these for $3, right? They're going for 450, so 450, but you also sold these 110 puts at 170. All right, so we're going to buy them back for 230, okay, because they're also up. But your spread is up $2.20 from $1.30. All right, Your spread's at $2. Thank you, Keshav. Your spread's at $2.20 from $1.30. Many times spreads will give you a higher return initially than your puts or calls alone. Okay, and if Amazon decides to stay here at 110 for some time, let's say Amazon decides to stay at 110 by Thursday, what happens to these values? If Amazon decides to stay near 110 by Thursday, what's going to happen to your spread if Amazon's trading at 110? Let me tell you guys. This 450 is probably going to be trading at 350 with 50-cent premium. This 230 at 110 is probably going to be trading at maybe around I would say $1.85 maybe. All right, what's the value of your spread? Even though both of them went down, but what's the value of your spread? 350 minus 185. I will not give this 185. Why even change this? This is probably trading near I would say $1.20. All right, your spread value, not even $1.20. I'm actually giving the wrong numbers here. I would say one max. All right, $1. Your spread value is at 250. All right. Now these numbers, obviously, I'm just making them up, but I'm actually showing you guys real life examples what this spread or the worth would be actually. This spread, if Amazon is trading by 110 by Thursday, the time decay that kicked in here, the theta that kicked in here, it went in your favor. These 113 puts went up by maybe 50 cents, but this 110 puts lost a lot of premium. So you actually made profits on 113 puts for buying and 110 puts for selling. You made profits both ways. Are you guys on with me on this? Making sense? Anything you're confused about, anything that might not make sense, go ahead, ask. That's the reason you're attending in live, or unmute yourself and you can ask. Okay. So 250. And personally, I would just sell my credit at 250 here. I don't even want to hold it because I'm almost near max profits. My max profits are 3, so why would I even want to hold it? All right. At 250, I take my exits, I'm out of the spread. I don't care, because on Friday, if Amazon bounces $2, let's say on Friday, Amazon decides to bounce towards 112. All right. If Amazon bounces towards 112 now, what happens here? These 110 puts are probably going to be going for around like 20 cents for Friday. And what happens with these puts? If Amazon's at 112, they're probably going to be going for $1.30 also. What happens to my spread here? Right? 130 minus 20. My spread's now at $1.10. Even though it's near break even, $1.30 is near break even. If you bought the puts alone, you would have lost a lot more. But because you're in the spread, you're still near break even. But you decided to hold, right? You did not take the profits at 250. Now it's trading at 110. Okay. The 113, because Keshav, 110 lost more value than the 113, right? It's actually more about the 110s that came in our favor. If Amazon keeps trading at 110 by Friday, the 113 has intrinsic value. There's less premium. The 110, because there was premium added on, because if we bought this spread on Monday for $3, and Amazon's now trading $2 lower, right now it's trading at 113, and on Friday or Thursday, Amazon's trading at 110. These 113 puts have lost a lot of premium along the way as well, right? Which was theta, right? Every day, or time decay. The and plus the added premium, and then intrinsic value just stays. Makes sense? Like intrinsic value is very important to understand. I'll just go over this quickly. Let's say if a stock is trading at 110, and I bought the 110 calls. Let's say I bought the 110 calls, right? I bought the 110 calls at 5. This is just an example. Ignore everything. I'm going to teach you guys intrinsic value. I bought 110 calls at 5. If the stock is trading at 105, what's the intrinsic value on 110 currently? Anyone? What's the intrinsic value here if the stock's trading at 105? It's actually is 0. Okay. If the stock's trading at 109, what's the intrinsic value here on 110 calls? It's still 0. If the stock's trading at 110, what's the intrinsic value here? 0. If the stock's trading at 116, what's the intrinsic value here on 110 calls? The intrinsic value here is 6. The intrinsic value is always the strike. All right, it's the difference between if the strike is trading under 110 and I'm in the 110 calls. So just listen to this. When you buy an option, let's say you bought the 110 calls, but the stock is trading under 110, there is no intrinsic value here. You're only paying complete premium. So as many times when you guys buy calls or puts, I'm going to teach you guys something here. Listen carefully. Let's say Tesla, if you're playing Tesla, Tesla is trading at 750 and you're buying the $800 call, anything above 750 on Tesla, if you're buying calls, there's zero intrinsic value. All right. So if whatever the strike the stock's trading at, anything above it, there's zero intrinsic value. At the money is zero. Anything in the money, all right, which we call ITM, anything in the money, it has intrinsic value. Let's say I'm just gonna, since we're going over Tesla, I'm just gonna teach you guys this because I mentioned intrinsic value a lot, so that will make more sense as I'm doing spreads. If Tesla's, let's say, is trading at let's say it's trading at 750, and I decide to buy the 745 calls. All right, my intrinsic value on these calls is $5. Plus, now let's say if these calls are priced at 25, right? I mean, on the weekly, many times you guys see Tesla is trading a lot, and let's say these calls are priced at $25. $5 is the intrinsic value. You're paying $20 premium for this, man. The break even alone on this, if you pay $25, the break even alone on Friday, if the market just grinds, is 745. Is 745 plus 25. Tesla better be at 770 by Friday just for you to break even. So when sometimes we LB, we mention that something is too expensive, it's because we understand that they're not priced fairly. All right. So if you did not know what intrinsic value was, that's something to learn. It does not take too long. It just takes a few minutes to understand. You can go on YouTube. They have some great tutorials, and that will make sense. All right. So when you're in the money, your intrinsic value is your strike minus the strike. Sorry, the current price of the stock minus the strike of in the money. That's the intrinsic value. And anything on top, you're paying premium. As simple as that. Make sense? The FedEx spread I did today. All right. So this what I went over. And let's say if Amazon happens to close at 110 but on Friday. Let's say if Amazon closes at 110, or let's say Amazon closes at 107 here. All right. Amazon closes at 107. All right. It closes at 107 by Friday. Okay. Now here, actually, I'm gonna give you guys a higher number so you guys can see some disadvantages of spreads as well. Amazon closes at 101 by Friday. There's a huge move down. All right. Let's say there's a huge move down and Amazon closes right here near the support. Okay. What happens here? Your 113 calls, right? Your 113 calls, if Amazon closes at 101, how much will be the 113 calls on Friday by closing if Amazon's closing near 101? What will be the price of 113 puts? Wrong, Google. What will be the price of 113 puts on Friday if Amazon closes at 101? Intrinsic value, come on.
Oh, sorry, 13, 12.
Yeah, you're $12 in the money now.
Yeah, my bad.
For puts. So $12. And what's the intrinsic value of 110? Anyone?
9.
9, exactly. So we get our $3 max profits. Our profits are maxed out. We can sell this for 3. We're done. But even though the disadvantage here is the put is somebody bought $3 puts, 3 to 12, they went up 300%. All right. But our spread, our max value was only 3. But we played this safe. So you guys understand what the disadvantages of spreads. We end up missing, like, if you're somebody that can that holds on to options, then we end up missing these one directional moves. We end up missing these one directional moves to one side if you have calls here. So spreads sometimes cap your profits. But let's say you're expecting a big move on Amazon. Let's say you're expecting a huge move down on Amazon. You think Amazon's going to close by 100 by Friday. All right. So let's look at what could have we done? We could have done. Instead of playing near the money spread, instead of playing near the money, we could have bought. So I'm going to teach you guys something here now. We can go far out also. We could have bought, we maybe could have bought, let's say 105 puts, just for an example. And we could have sold, let's say 100 puts against it, just an example. Let's say these 105 puts were probably going for, just a rough guess, let's say 50 cents, and you sold these at 20 cents. Or you sold these at 20 cents. All right. And Amazon by Friday actually closes from 113 to 101. What's the intrinsic value on 105 spreads by Friday? If Amazon closes at 101, $4, right? Good job. So that's one thing that you guys are learning. What's the intrinsic value of 100 puts if Amazon closes at 101? So let's say these puts are expiring at 0. All right. So what's the max value of these spreads, by the way? What's the max value of this spread? 105, 100. What's the max value? 5, right? And what are the max profits? And our spread cost is 0.30. What's the max profits? 470, right? Now, because it closed at 101, 100 puts are gone to 0. So we made money on this 20-cent credit. So we get to keep this 20 cents also. And plus these 50-cent puts went to 4. What's our spread at? $4. From 30 cents to $4. This actually paid you guys more than what these options would have paid you on its own. 50 cents to $4 is only 700% increase, but 30 cents to $4 is more than 1,000%. Make sense? So spreads can sometimes even pay you more than put if you're expecting a big move down. And here, instead of paying 50 cents for this, we cut down our cost by 40%. We slashed our cost for 105 plus by 40%. Make sense? Right? So another scenario I want to give you guys here now is, if you want to be really safe, you think Amazon closes around 113. You think Amazon does nothing, it closes at 113. How can you make money on this? Okay. Well, we look at the 115 puts and we sell the 113 puts. Let's say 113 puts. If you want to be really safe, you want to make some conservative gains, you're not looking for bangers, you're just looking at conservative gains, consistency. 113 puts, we already know they were priced at $3. How about 115 puts? Roughly. I would say maybe $4.85. Just a guess, sorry. Just a guess. What's the call? What's the max value of these? No, sorry, not 485. Sorry. This 115 puts, because they're both in the money, it'll be maybe at $4.10, I would say, maybe. So what's the max value of this spread, guys? What's the max value? $2. And the max profits? I'm sorry. The max profits here are, oh no. First, we gotta get the cost right. 410 minus 3. So the cost for our spread is 110. Our max profit is only up to 2. And then our max profits are 2 minus 110 our cost. So 90 cents. Now I have one rule. I have one rule of thumb when I do spreads. I will never pay more than 50% of max value for a spread, all right? Because our gains are limited. Is this close to 50%? It is almost, all right? This is a 45%. I would do this, but the cost is the price of the spread, guys. Okay, so cost is the price of the spread, right? Like it costs us $1.10 to buy the spread, all right? Now here, Amazon's trading at 113.22. Your spread, this is very important. Why is this place so safe? Your spread is already in the money. What's the intrinsic value of the spread, guys? What's the intrinsic value here? What's the intrinsic value? Let's see who gets this. What is the intrinsic value of the spread? I'm asking about I'm asking the intrinsic value, not the max value. I'm asking the intrinsic value of the spread. 110 is the cost, but what's the intrinsic value? What is the intrinsic value for you to break even of the spread? Anyone? Anyone? Oh, hell no. You went way out of the money. You're out on the puts, intrinsic value is under the strike, not above it. Come on, guys. For you to break even, where does Amazon has to close for you to break even? Think. Okay, I'm doing a bad job at teaching clearly. Your intrinsic value is 115 minus your cost. All right, your intrinsic value is 115 minus $1.10. 113.90. As long as Amazon closes at 113.90 or under, you're in profits or you're break even. Amazon here is trading at $13.22. Try this tomorrow. Look at the cost of spreads. All right, you're already in the money on this spread. That's why your max profits from 110 is only $2. If Amazon even just goes sideways here and choppy, it does nothing, you're going to make money every day. Why are you going to make money every day on this spread? Because your 113 is all premium. All right, this is all premium. This has premium plus $2 of intrinsic value. And this is going to lose more premium than the 410s every day. And that loss is your profit. So let's say by Friday, Amazon closes at 113.50. Amazon closes at 113.50 by Friday. All right. How much are the 115 puts maybe at that time? Well, $1.50 is the intrinsic value, as we know. Maybe they're going for $1.75. The 115, and then the 113 puts, there is not intrinsic, it's not in the money, but there will still be some value left. How much, roughly? If it's trading on Friday, 113 puts might be going for maybe, let's say, I don't know, at that time, I would say 30 cents maybe. So what's my spread value now? 117 minus 30 cents, $1.45. I'm still up on my spread. Even though these puts got slashed in more than, so these 115 puts got slashed, they lost more than 50% of the value. All right. They lost more than 15% of the value right here. But these 113 puts lost a lot of premium. You made money here, but you lost some money here. But overall, you made money. All right. You made $2.70 on this, and then you lost $2.35 here. So that difference of 35 cents is your profit. How cool is this, guys? Tell me this is freaking amazing. It is, right? So spreads, grow accounts is consistency. They're not 500,000% plays. When I do butterflies, they're obviously much more advanced and they give the highest percentage returns. Some of you guys have been here. Gurvinder, Red Starburst, you guys have seen me hit butterflies for 2000% so many times. And that season will start again soon, right? But right now, the market just not right for that. And but you guys see how safe this play was. You guys were already in the money on this play entering. Why? Because you were collecting this high premium or high IV. Okay. Did this make sense? How this spread made you profits when both of these went down? So these are called bear put debit spreads, guys. All right. They have some different, some people call them bear spreads, some call them put debits, but bear spreads could be puts and in calls and both. Okay, it does. So make sure you're okay with the terminology. But put debits is what this is. Does this make sense? Because then I want to move on to put credits. Did this make sense? Yes. See? Yes. Awesome. If it didn't, don't worry. It'll be up again. You guys can watch it again. So let's get rid of put debits. Now, let's say if we want to collect a premium. Let's say you think Amazon is not going to go down. Amazon's going to hold above this support and it holds and consolidates here. But we want to collect some premium. This right here underneath, we want to collect some premium from here. We want to, we want to sell some options to people. All right. We want to collect some premiums. So we do put credit spreads. All right. Put credit spreads. They're the opposite of the put debit spreads. So here, basically what happens is, let's say we think Amazon holds above 13 all week. Amazon consolidates and holds above 113 all week, for example, or maybe it goes down, but then eventually comes back up. All right. So what we will do here, maybe let's look at 112 puts and then maybe 110 puts. All right. And this spread between the strikes, as you get more used to it, they will make more sense. And then you can keep them for whatever value you want. Different returns happen, but this you got to do it practically to understand. So here, instead of buying 112 puts, I'm going to be selling 112 puts and I will buy 110 puts. All right. Instead of selling naked puts here, I'm going to be selling 112 puts right closer to the money and I'm going to be buying the 110 puts. Why? Because if Amazon flushes, market crashes, something happens, there's a lot of risk to the downside. But if I have the 110 puts bought, I am protected. I am protected. All right, so we'll go over this right now. You'll understand. Well, if I want to collect premium, 112 puts, let's say Amazon's trading at 113. I'm just going to make up these numbers. Let's say they're trading at 250, for example, and then 110 puts are maybe trading at, let's say $1.55-ish, for example. All right, just an example. Now here we receive $250. So the market maker gives you $250, and then you sell, you buy the 110 puts. You collect 150, you pay 155. out of these 250. So what's the difference remaining of this credit? So 250 minus 155, this $95 came to your pocket. So if your account starting balance was 5,000, and now your account balance is all of a sudden 5,095. Instead of giving the market money, you have 5,095, and the market maker holds some money against your spread as your buying power in case it goes down and you have to buy it back for more. All right. Now, again, the first question, what's the max value of the spread? What's the max value? 2. Okay. And what are the max profits here? Then before you answer, think, don't be fast. I know what you guys are going to do. Think before you tell me the max. What are the max profits here? What are the max profits? You're wrong, Gurvish. That's not your max profits. That's your max loss. $1.05 is your max loss. What are the max profits? I don't know how you got 207. Nope. Come on, guys. Yes, Keshav. Our max profits is $95. We sold this for $250. We collected $250. We gave back $155 for buying this. So $95 credit is our max profit. The credit we collected from the market. This is our max profits, $95. Our max loss is $1.05 if something was to go against Amazon, something happened. Now, let's say by Friday, let's say, for example, this is trading at 95. Whatever Amazon does by Friday, and Amazon's trading at, let's say 113, same. Let's say Amazon just trading at the same price. So we'll go with these different scenarios. Let's say Amazon's trading at 113 by Thursday, all right? How do we make money? What's the value maybe of 112 puts by Thursday or Friday? Or Thursday, I will say maybe let's say $1, and 110 puts, maybe, I don't know, 50. It will actually be less, but let's just say this. What's the value of this spread now? The value of this spread is this. Currently is going for 50 cents. You collected $95. Now, this spread has lost a lot of value. You collected $95. Right now it's going for 50 cents. You can choose to close this spread at 50 cents. If you choose to close this spread at 50 cents, what is your profits? $45. That $45 stays in your pocket free. You collected premium from the market. Make sense? Make sense? And let's say, come on, Keshav. You collected $95 credit from the market. Okay, you collected $95. You sold the 112 puts for $250. You bought the 110.50 puts to protect yourself in case Amazon falls further. So you already know your max loss is $1.05 on this, whatever happens, and max profits are $95 because the max value is $2, right? So $0.95 max profits. Okay, which is $95 monetarily. Now, let's say by Thursday, Amazon's trading in the same range at 113. What happens to these two values? They lose premium. They lose premium. They lose a lot of premium, or time decay as we call it. On Thursday, let's say the 112 puts are going for $1 and the 110 puts are going for 50 cents. The value of these spreads is now 50 cents. You collected, like you sold this spread to the market. You did not buy. You collected $95, and now you're buying it back for 50 cents. So that $45 difference is your profits. Make sense? So here, we're not just buying puts and calls. Here, we're also going advanced of collecting premium. These two strategies that I'm going over, the MSL series 1 lesson, bull call spreads, and this ML series lesson 2 for bear put spreads. These are the two most basic strategies. There's at least 15, 20 other strategies in the market which are way more advanced, and you can even make much more money. Like, there's so many. It's just a matter of putting the hard work in. All right. So, and now let's say you think Amazon goes up. There's good news in the market's going up, and you think Amazon makes a move up. You think Amazon on Friday runs, or maybe it closes good. Let's say Amazon closes near 115 on Friday, or is trading near 115 by the daytime. What do you think the 112 puts will be going for? Maybe, I don't know, 35 cents max. And it'll be way less, but I'm just giving it more. And these might be going for 15 cents maybe. Let's say, for example, what's the value of these spreads? 0.20 only. I would personally just cover it at 20 cents and lock in that $75 profit. Make sense? Yes, Keshav, this put credits you're selling premium. You're not playing to the downside. Here, you're not playing the spreads I was covering earlier put debit, you're playing for the market to hold or go down. Now, these put credits, you're basically collecting premium. So you want the market to hold above your intrinsic value of the spread, right? And then hold or go up here. That's what we want. Only then these two lose value. And what's the intrinsic value of the spread, guys? What's the intrinsic value of the spread? Let's see who gets this right. What's the intrinsic value of the spread? Who's going to get this right? What's the intrinsic value here? Let's see if anyone gets this right. Thank you for your answer. And you guys should know this by now. You guys should know this by now. What is the intrinsic value? Come on, it shouldn't take you guys this long. No, you're going out of the money. Your intrinsic value, if your max profits are 95, what's the intrinsic value here? The spread value by Friday has to be just 95, so you break even. So when do you break even on this spread by Friday? What's the intrinsic value here? I don't know how you got 94 or 5. I have no idea how you got 94 or 5. You're way out of line. You're very close. You're almost there. Think again. You're almost there, almost. CMOS 2 is the max value. What's the intrinsic value here? For us to break even on Friday, where does Amazon close? Our max profits are 95 cents. So where does Amazon close? Our intrinsic value, I can't believe that you guys got this wrong. I mean, not wrong, but no. So 112, all right. 110 has to be 0. So 110 has to be 0. 112 minus 0.95. So our intrinsic value is $111.05. So as long as, Dave, nice. So as long as 111.05 Amazon closes there, we break even on our spread. So you're still giving yourself downside here to play. So even if this Amazon comes down, you still give yourself down. Even though you collected premium, you're still giving yourself almost $2 for Amazon to go down, and you can still break even. You see how safe these plays are? You see the safety of these plays, right? So even if Amazon, you're giving yourself room. That even if Amazon goes $2, it's okay, and maybe it bounces, the market holds. So there's so much money to be made in the spreads. So intrinsic value here is a 111.05 because our max profits are $95. Does this make sense? And now you guys have no idea, but I've been talking for 40 minutes, right? So did you guys know it's been 40 minutes since we're in the session? You did not, right? Time flies. Even I didn't know that it's been 40 minutes. So teaching goes fast, right? But so this is it, guys. And let's say if Amazon, how do we lose money on this? Let's say something happened in the market, the spread goes against you, right? Losses happen in the market, we have to embrace it. And Amazon comes and closes at, let's say 110.50. If Amazon closes at 110.50, let's say, for example, all right, let's say Amazon closes at 110.50. Amazon chooses to decide to close at 110.50. What's the value of 112 if Amazon closes at 110.50 on Friday and we hold this till the end? What's the value? 112 puts 150, yes. What's the value of 110 puts on Friday close if Amazon closes at 110.50? What's the value of 110 puts? No, Keshav. Amazon's closing at 110.50. If 110 puts, nice Google, 0. 110 is out of the money, right? We're talking about puts here, not calls, right? So puts, intrinsic values to the downside, not upside. Okay, so if Amazon closes at 110.50, 110 puts they're expiring as 0. Okay, so this spread is now worth $1.50. Okay, we collected $95 on it. So what happens here now? We gotta buy this back from the market at $1.50. So we incur a loss of 55 cents here. Now, all right, we incur a loss. Okay. So you have to know both sides. So now we're buying this back from 150. Why is the 55 cents loss? Because we collected $95 from the market, but now we gotta buy back from 150 because we gotta buy these puts back that we sold. Okay, the value of the entire spread is $150, and we collected 95. So now this equals this. So $55 we pay out of our pocket. Make sense? Just so you guys understand the losses as well. So guys, spreads are beautiful. I'm gonna post this. I will upload this by tomorrow or maybe even tonight. So make sure you guys look into this. And they've, but you know what, guys? If you guys learn these things, I have so many strategies that I can teach you guys. There's diagonals, right? But first, you guys gotta know this. There's diagonals, there's butterflies, there's iron flies, there's condors. There's so much. There's so much in the market that I can teach you guys this. And these diagonals also, it's not just one type. They're it's different. Butterflies also, it's not just one. They're different kinds. Iron flies is just not just one. They're different kinds. Condors, it's not just one. There's different kinds. All right, it just gets advanced and advanced. But once you learn these things, you can use the data that I pulled. You guys can use the gamma levels I pulled. You guys can use the options levels I tell you guys to make all the money you want in the world, right? And yes, I do them. I don't post all my strategies in the group because just don't want to confuse people. But that's the reason I chose to do this MSL series, so you guys learn one by one, right? And so what are the strats to downside you play when you think the market is going to go down and you want to make money on the premium burn? If you think the market is going to go down, but you want to make money on the premium burn, I got your question, but well, if you think the market is going to go down, okay. To put it easy, if you think the market goes down here, you can sell premium above, which is known as bear call spreads. The session is in the premium. I did this last time, bear call spreads. So here, basically, I will sell. It depends on strikes, but I'm just an example. Let's say I sell 113 calls here, and I buy 115 calls to protect myself. 115 calls I buy, right? And 113 calls I sell. Okay, because these 113 calls, let's say they're priced at, just an example, at 2, 115 calls are priced at 1, I can collect that $1 premium. All right, I can collect that $1 in premium. Make sense? Yes, they're called bear call spreads. And today I basically did bear calls. Well, let's go over the FDX spreads I did today. FDX spreads I did, my premium strategies load. Okay, so basically here's what I did on FDX today, the play I did today. I'm gonna show you guys. On FDX, I did the bear call spreads. All right. Now I bought myself a lot of time. I went August 19. All right. I went August 19. Now let's look at FDX chart here. So this is what I did today. Now I collected some premium on FDX and I'm just going to sit on it and not do nothing. All right. My goal is, and look at this chart. All right. The chart has, in this market, this stock is already up from the last 197 to 250. That's a 25% increase in this piece of shit market right now on FDX. All right. And we have a lot of demand and supply here, a lot of demand and supply, a lot of sideways movement. Even if FTX goes up here, I'm pretty sure I get a retest of the same level after 2-3 weeks. All right. Now these August 19 spreads, I basically, what I did was I did 240 calls and 260 calls. I don't know how much these were going for, I forgot, but I do remember the value of my spreads 9. So I'll just use some random numbers to you know, give you guys an idea. So the 240 calls, let me see if I have them on my phone so I can just go over the exact numbers. Hold on. Nope, it doesn't. I was looking on my phone. But anyways, no, this is a bear call spread I did today. So please watch, Keshav. So on 240 calls, I sold these calls. Why did I sell these calls? Because I took advantage of this huge move up and the increase of IV in calls. And the one moment when there's a big directional move, you guys have seen in the past, the options go up by a lot. All right, the options go up by a lot. So I want to collect that premium while it's there. So at 240 calls I sold, and then the 260 calls I bought in case if FedEx was, you know, some positive news come on the Fed and this keeps going up, which we've seen in the market, anything is possible. I want to protect myself. So these 240 calls, I think I sold them for I don't know, but I'm just gonna make up the numbers here. Let's say 20 bucks and 260 calls. I probably, you know, bought them for 11 bucks. All right, they should be around here unless somebody wants to go online and check for me what they close their trade. But anyways, so I sold these to $20 and I bought these at $11. Now check this, check the beauty of this play, guys. Check the beauty of this play. Number one, what's the max value of this spread? Max value, somebody fast. Come on. What's the max value? The max, yes, 20. What are the max profits? What are the max profits? What are the max profits? Exactly. And max loss is obviously 20 minus 9, right? Max loss is 11. What's the intrinsic value of this spread? What's the intrinsic value of the spread? What's the, yes, I got filled at 9 because I lowered it to $9. So what's the intrinsic value? What's the intrinsic value of this spread? Where do I break even? On by August 19, let's say if I decide to hold, whatever happens, what's my break even? Come on, Keshav. Nope. Negative. What's my break even? My max profits are 2, this. My max loss is 11. What's my break even? You're close, Devinder, but not exactly right. What's my break even? My break even. My max profits are $9, right? $900. What's my break even? Exactly. So 249 would be my intrinsic value. All right, because I sold the 240 calls, right? I sold the 240 calls. So the max I can have by August 19 for me to break even is FTX trading at 249. That makes $9 value, and these goes to 0. Basically, I make no money on the spread then. But now here's the thing. I expect this will be a great play. This will be a great play. I'm going over this live, and let's see by Friday what the value of these spreads is, right? This so if FTX just even does whatever here, consolidates whatever it does, comes and fills a gap in the next 2 weeks, whatever it does. Let's say FTX after 1 month, what's the date today? June 27th. Let's say by I don't know if the market is closed on July 27 or not. What's the date? July. So July. Let's go with July 22nd. Let's say, for example, July 22nd. I know that's expiry date. I remember. So let's say by July 22nd, FedEx, nothing happened in the market. FedEx is holding strong. Let's say, for example, if FedEx does this down movement, it goes up, is holding strong, is still holding near 240 in the supply, a strong supply and demand. The 240 calls, they had a lot of premium in them. 1 month of time decay on these calls. What do you guys think they will be going for? I think they'll be going for $13 or so. They will lose a lot of value in a month. All right, they'll be going for 13. Actually, not even 13. They should be going for maybe 10. They because this all this $20 is nothing for premium on these, right? So these calls will be worth $10. What will the 260 be worth? Roughly. What will they be worth? Roughly. I would say 350. Just making up numbers. Let's say 350. So July 22nd, FedEx is trading at 240 again, same price where it closed today. All right. What is the max value? What's the value of this spread right now? What's the value of this spread? Right, 650. How much did I collect on this? $9. I can choose to buy this back for 650. And what are my profits? 9 minus 650. I did nothing. I sat. I let FedEx do whatever the hell it wants. I'm walking away with $2.50. It will actually be worth a lot more, I think. I will actually have more profits after a month, but I just made up these numbers. I'm walking away with $2.50 collected in premium. Amazing, right? Let's say FedEx today is trading at 240. Let's say I hold this spread. Let's say I hold this spread into August 19th. All right. And let me give some upside to FedEx. Right? Forget the downside. Let's say likely it closes at 245, for example. What's the intrinsic value of 240 on expiry? 5. 260 is 0. The value of spread is 5. I collected 9. They're going for 5. I still make how much? $400 per spread profit on premium. So these things exist in the market for you guys to make money. It's just a matter of exploring them. You don't just have to buy calls and put. Now, yes, call and put, you can make more money, but calls and puts alone, they require a lot of discipline, patience, discipline, and great timing. All right. If you're having trouble with all these three, if you're having trouble with even one of them, spreads can help you. All right. There's nobody more patient than me in MSL. Forget MSL. I think the top 100% of the trading world, I probably belong to the very rare 0.01 when it comes to patience. I can sit on the screens every day for a month and not trade. That's me, guys. All right. I've given my, I was, I think 17 years old when I started trading. I am now 30. I got 13 years in, and in those 13 years, I had 8 to 10 years. My 8 to 10 years were bad. All right. Like I'm being honest with you guys, I'm very transparent. But the last couple of years, I've changed my game. I've changed who I am. Why? Because I had my risk tolerance. I was young. I did not have any bills to pay, but now I pay my bills through trading. I pay my mortgage through trading. I pay a lot of shit through trading now. So I had to learn this in order to do this full time. So when I put a lot of work into all these gamma reports study, that's because I'm doing this full time. This pays my bills. All right. Now I'm at a different game. God bless. It only took me 1 year to recover everything and obviously profits. But you guys can. It's up to you how much work you guys want to put in. It's all up to you. To me, it did not come overnight. I was a very young kid when I learned, right? And so all these things, there's a lot. There are many ways to make money in the market. It's up to you guys. And what percentage of my trades are spreads? Well, I would say 50-50. But in this market, I'm scalping more as you guys, so 50-50, I would say, right? 50-50. It depends on the market, right? Right now, market is holding, is slowly grinding. So I shifted a little towards spreads, as you guys see, right? And I think if the market goes a little bit more higher, I will do more spreads, right? More, I will probably collect more premium. Bear call spreads. So keep an eye on bear call spreads. They're very safe. And let's see. And if you do these spreads in the normal market, there's so much money to be made. There's so much. Some of these guys know. There's some of these guys some know. Demand supply. We can do it. We can do it. Sometime I can do the live. And then we can go over it then. And so guys, that's almost 1 hour. I hope bear put spread. This was consider this an introduction to yourself if you did not know what these things were. Let's see where the market goes. Let's see where the market goes. But I'm just gonna go over SPX quickly for you guys. Only the people that are attending, I'm gonna give you guys this analysis. We are far away from the bottom. That's all I'm gonna say. The bottom in the market will be the day we hit this zone right here, this breakout zone. This is when the market will bottom, in my opinion, which happens to be 3,200. So for some months, we can even go up here. We can even go all the way back up to 4,300, 4,400, and then come back here. It's going to happen. I'm pretty sure. I could be wrong. Nothing is guaranteed, but keep this in mind. I gave this zone, not that I'm taking any credit or anything. I gave this zone to you guys when the market was right here. Those that have been attending pre-market, I gave you guys this breakout zone that is going to get tested. It did. This is next in the markets. I'm telling you guys. That's just my own opinion. You guys don't have to believe me. Now let's go over the 3-month chart on SPX. This is, I'm not saying we're going to get something like this. This was a very strong breakout, but expect this retest. All right, expect this retest of April 20 or COVID retest. That's all I'm expecting. Let's see if it does or not. And the biggest gift in the market, which many people don't believe, I've studied the options inside out on Tesla. All right, I've studied it inside and out. These lows are going to be tested, which is 546. And then this monthly low is also going to be tested, likely. I don't know if this is going to get tested, but these lows are very likely to get tested because that's when they're going to put the option structures on it for the coming years for 2024 and 25. That's when, because options are basically cheat codes in the market. Options navigate the big moves. All this huge move that happened on Tesla, it was backed up by options. It was not just buying alone. And these options that took this move up, they are removed from the market. This is what people don't know about Tesla, which Ricky knows and which Ricky is telling you. God bless. See you guys back in the chat.
Thank you, Ricky.
No problem.
See you tomorrow.
See you.
Thank you, Ricky.
Brother. Thank you.